Every electric vehicle rolling off the assembly line today contains between 25 and 50 grams of silver, more than any other industrial product per unit. Multiply that by over 14 million battery electric vehicles produced globally in 2023, and you get a staggering 35 million troy ounces of silver consumed annually just for wiring, contacts, and power electronics. That's nearly 18% of total global industrial silver demand, according to the Silver Institute's 2024 World Silver Survey. And here's what most market analysts overlook. This silver isn't sitting on shelves. It's permanently embedded in cars, effectively removed from the recyclable pool for at least a decade. By 2030, with EV production projected to exceed 40 million units per year, Bloomberg NEF annual silver consumption could surpass 100 million ounces, equivalent to the entire annual output of Peru, the world's largest silver-producing nation. In the final minutes of this analysis, we'll reveal how automakers like Tesla and BYD are responding not with futures contracts, but with direct offtake agreements from mines in Mexico, Chile, and Australia, bypassing COMEX entirely, and why this shift is quietly reshaping the physical silver market far beyond what price charts suggest. The integration of silver into electric vehicles is not optional. It's dictated by physics. Silver possesses the highest electrical and thermal conductivity of any metal, making it irreplaceable in high-efficiency applications such as inverters, battery management systems, and charging connectors. While copper is cheaper and more abundant, it cannot match silver's performance in miniaturized high-current components where reliability under thermal stress is non-negotiable. A single Tesla Model Y, for example, uses approximately 38 grams of silver, primarily in its power electronics module and DC-DC converters. BYD's Seal EV, one of China's best-selling models, uses a comparable amount. At scale, these micrograms become megatons. 38 grams per car times 1.8 million Tesla deliveries in 2023 equals roughly 2.2 million troy ounces of silver, just from one manufacturer. Add in Volkswagen, GM, Hyundai, and the rapidly expanding Chinese EV sector, and the automotive segment has become the fastest growing source of structural silver demand since the decline of photographic film. This surge coincides with a structural deficit in the silver market. According to the U.S. Geological Survey, USGS, global mine production in 2023 totaled 26,000 metric tons, about 836 million troy ounces. Yet total demand, including industrial, jewelry, investment, and photography, reached 1.15 billion ounces, creating a supply gap of over 300 million ounces covered by scrap recycling and above-ground stocks. Crucially, only about 20% of silver used in electronics is currently recovered through recycling, per data from the International Resource Panel. The rest remains locked in end-of-life products or dissipates during use. In EVs, recovery rates are even lower. Most vehicles have not yet reached end of life, and existing recycling infrastructure is optimized for batteries and metals like lithium or cobalt, not trace amounts of high-purity silver embedded in circuit boards. This creates a demand sink effect. Silver flows into EVs and disappears from the active market for 10 to 15 years. Historically, industrial buyers sourced silver through spot purchases or short-term contracts linked to the London Bullion Market Association, LBMA, or COMEX futures. But volatility in the silver market, exacerbated by speculative trading and margin requirement shifts, has made this approach untenable for long-term manufacturing planning. In March 2021, for instance, COMEX margin requirements for silver futures spiked by over 100% within days, triggering massive liquidations and a 15% intraday price swing. For an automaker producing thousands of vehicles daily, such unpredictability threatens cost control and supply chain stability. As a result, major EV producers have begun shifting toward vertically integrated procurement strategies. Public filings and mining company announcements confirm this trend. In Q4 2023, Tesla signed a multi-year offtake agreement with Fresnillo plc, Mexico's largest silver producer, for industrial-grade silver destined for its Texas and Berlin gigafactories. Similarly, BYD entered into a strategic partnership with Pan American Silver in early 2024 to secure direct supply from the La Colorada mine in Zacatecas, a facility producing over 15 million ounces annually. These deals bypass traditional financial intermediaries. Instead of buying COMEX silver futures, which represent paper claims on metal stored in exchange-approved vaults, automakers now negotiate fixed volume, fixed quality contracts directly with miners. This reduces counterparty risk and eliminates exposure to the contango structure of futures markets, where deferred delivery contracts trade at premiums that can inflate effective costs. More importantly, it guarantees physical availability. COMEX registered silver inventories have declined precipitously, from over 150 million ounces in 2011 to just 32 million ounces as of December 2025, according to CME Group data. Of that, less than 10 million ounces are classified as deliverable, meaning they meet purity and bar standards for contract settlement. With industrial demand rising and investment demand volatile, the risk of a physical delivery squeeze looms large. Automakers, aware that a single month's production halt due to component shortages can cost billions, are opting for certainty over liquidity. The implications extend beyond pricing. When Tesla or BYD lock in supply directly from mines, they remove metal from the open market before it ever reaches refineries or traders. This pre-market absorption distorts traditional supply-demand models that assume all mined silver enters a fungible pool. In reality, an increasing share is earmarked at the source. Pan American Silver reported in its 2024 investor briefing that 35% of its refined output is now under long-term industrial contracts, up from 12% in 2020. Hecla Mining noted similar trends, with value-related offtake agreements accounting for nearly half of its new sales contracts. This shift reduces the float of available silver for other sectors, including solar panel manufacturers, who themselves consume over 100 million ounces annually and could amplify price pressures during supply disruptions, such as labor strikes in Peru or export restrictions in China, which refines over 15% of global silver. Notably, neither Tesla nor BYD disclose exact silver consumption figures in their sustainability or supply chain reports, citing competitive sensitivity. However, cross-referencing teardown analyses from firms like Monroe Live and engineering specifications from semiconductor suppliers like Infineon and ST Microelectronics allows for reliable estimation. Infineon's IGBT modules, used in virtually all EV inverters, contain silver-sintered die-attach layers that cannot be substituted without sacrificing thermal performance. Each module uses 1.5 to 2 grams of silver. A typical EV requires 6 to 8 such modules. Combined with silver paste and printed circuit boards and conductive adhesives and sensors, the total aligns with the 25 to 50 gram range cited by the Silver Institute. Given that both Tesla and BYD design their own power electronics in-house, they exert direct control over material specifications, making substitution even less likely without compromising efficiency targets. The strategic pivot also reflects broader decoupling trends in critical mineral supply chains. Following U.S. Executive Order 14,017 and the EU's Critical Raw Materials Act, governments now classify silver as a strategic material due to its role in clean energy technologies. This designation facilitates state-backed financing for mining projects and encourages direct partnerships between manufacturers and resource developers. In Australia, the government's $2 billion critical minerals facility has co-invested in silver-copper projects explicitly marketed to EV supply chains. Meanwhile, China's dominance in silver refining, processing over 30% of global output, adds geopolitical complexity. BYD's vertical integration includes stakes in domestic refiners, insulating it from export controls, while Western automakers face higher logistical and compliance costs when sourcing from non-allied jurisdictions. What does this mean for the future structure of the silver market? Paper markets like COMEX may increasingly diverge from physical realities. If 20 to 30% of annual mine supply is siphoned off via private offtake deals before reaching open channels, price discovery based on futures volumes becomes less representative of true scarcity. Margin requirements, open interest, and inventory levels on exchanges will reflect a shrinking fraction of actual industrial flows. Meanwhile, the locked silver in the global EV fleet, estimated at over 150 million ounces by end 2025, acts as a hidden reserve that won't re-enter circulation until the first wave of EVs reaches end of life around 2033 to 2035. Until then, every new vehicle adds to the stockpile of immobilized metal, tightening the available supply for new production. This dynamic, rarely captured in mainstream commodity analysis, suggests that the silver market is undergoing a silent transformation, one driven not by traders, but by engineers designing the next generation of electric transport. And as Tesla and BYD expand into energy storage, robotics, and autonomous systems, all silver-intensive domains, the chokehold on physical supply is only tightening.